A rocky start in September, logging 3 straight days of losses, led by declines in Apple and also Nvidia. The sector, which was buoyed earlier this year by AI hype, is now feeling the pressure from the possibility of higher rates as the U.S. economy sees stronger than expected economic data. Just this morning, we had jobless claims coming in a little bit lower than last week. We talked about Apple feeling extra heat as the company's iPhones are perhaps caught in the crosshairs of U.S.-China trade tensions with that potential a soft ban that we talked about. Let's talk more about the so-called Magnificent Seven and what comes next. Let's bring in Kristen Bitterly, Citi Global Wealth Head of North American Investments. Kristen, good to see you.
Good to see you too.
So you heard us talking about Apple, but we have seen a bigger sort of rollover in just the first couple days of what feels like back to school season, right? In these tech firms. What does that tell you? Is this going to continue? Is there going to be some rocky times for these stocks?
I think it's interesting because what we saw obviously in the first half of the year was that these stocks were really the flight to quality. They're the free cash flow generating ones, the Magnificent Seven, really driving the entire rally that we saw for the first half of this year. August was a very different story, really kind of a tale of two different months. And then September, you get into the seasonal effect of it tends to be one of the most volatile months. And October, actually realized volatility in October tends to be even higher than in September. So I think this is the market working through a number of different things. It's the Fed's trajectory from here, some of the catalysts that we have on the horizon, and also just looking at the resiliency of the overall market.
Is that a missed rally then? If anybody's looking at the Magnificent Seven at this point, so many different names that we could kind of prescribe to the seven, but if they were looking at this and trying to evaluate if there's still further upside potential, given all of the tailwinds that many of them were able to ride, whether it be free cash flow or the companies that are sitting on the biggest hoard of cash or able to deploy that into future investments as well, is that a missed rally?
I don't think it's an entirely missed rally because what I was saying earlier just about free cash flow generation and this idea that if we are in an environment where you're going to have higher rates for longer, then obviously you would want companies in your portfolio that have really strong balance sheets. But I also think if you are in the camp where you believe that we could see a soft landing scenario, that then you would anticipate that this rally could broaden out into other parts of the market. So for example, looking at the equal weighted version of the S&P 500 versus the market capitalization weighted, that's a very easy and elegant way to say I'm going to play the broadening out of this rally. Looking at areas like mid cap that are trading still at like a 30% discount to large cap and finding those opportunities where the valuation makes sense, the entry point makes sense, and that you haven't really seen a lot of flows into it year to date.
I do want to ask you one more question about big tech, though, and it has to do with China. We have the Apple situation this morning. We also have a couple of congressmen saying they want to see export sales further restricted and maybe some further curbs put on China's biggest chip maker. Does the market fully appreciate the potential risk specifically to big tech from slowing China growth and the tension between the two nations?
Well, I think the interesting part of that is that you have slowing China growth, but there's still a lot of uncertainty as to what the Chinese government is going to do. And so if we look at the local Chinese equity market, off about 20% year to date, off over 50% from all-time highs. And so there is concern there as to, if the Chinese government did change their stance and all of a sudden started to stimulate in a more meaningful way, not a 10 basis point cut in rates, but a more meaningful way, what could that do in terms of the broader economic picture? But I think that's an overarching risk, not just for tech companies, but when we're talking about what are some of the risks on the horizon to this soft landing scenario, you have to factor in Chinese growth, just given the fact that they are the second largest economy in the world.
And so in that second largest economy, I mean, we've seen a shift in sentiment around some of the U.S. names, even trying to either put technology on the business to business side or even the business to consumer and the handset or smartphone category, as we were just talking about a moment ago. Is there a waning of sentiment that could further impact U.S. companies who are trying to still make sure that they're engaging with consumers more internationally?
I think, well, the international question is a broader international question. Yeah. China's obviously an important part of that. But the broader international question, I mean, you look at India, for example, that has just overtaken China from a population standpoint. So there is an argument in terms of like valuation and where you're seeing opportunity outside the U.S. and that disconnect. And so it's just not a uniquely China story.
And so if Okay, if you're looking in the U.S. and saying mid-cap provides some interesting valuations here, when you're looking internationally, what's the analog for that? Is there another area that you think is attractive?
So what I would say is when you compare the U.S. to international equities, the U.S. a lot, as we just discussed with some of these tech stocks, a lot of the good news is priced in. And even if you look at something like our economic surprises index, you have kind of the positive side in U.S. equities, and pretty much a lot of negative news is priced into international equities. You have about, U.S. represents 65% of global market capitalization and only 50% of the earnings. So I think looking broadly in terms of some of the multinational companies in sectors that we really like, so healthcare, investing in longevity is a great example that from a valuation standpoint has not really caught a bid. It is not a uniquely U.S. story. It's one that you can actually invest in internationally. And we think that makes sense, not just for the short term, but for the longer term as well.